Okay, good evening, everyone, and welcome to our first presentation here. We'll try and do these, once a week, once every other week. Really depends on my schedule. But definitely want to, put some content together so that people can benefit. Because, you may or may not have, some insight into what's been going on, but I've really gotten to the point where I'm absolutely appalled by the current situation with all of these different paid rooms. And, I'm not going to name anyone or any group in particular, but there's a lot of practices that are currently going on that I simply just don't agree with. As things come out and whatnot, you will understand why. To me personally, if you are paying for a service, there needs to be a certain level of quality to that material, okay, or to that service, whether you're paying $20 a month or whether you're paying $200 a month, there has to be value. And unfortunately, with a lot of these groups that are out there isn't the value. And at the same time, I hate to say this, but it really seems like, they make it seem like they care, but they really don't. It's just about, increasing numbers and selling memberships and, what's the subscriber count? And so, having been able to see what goes on behind the scenes, can't stay quiet for any longer. And so the whole idea behind this presentation today is to teach you about the TTM Squeeze. And for those of you that have already taken it, this will be a refresher. For those of you that are new to it, please do not hesitate to ask questions, okay? If you have a question, simply ask. I am never going to say that's a stupid question. You're never going to get ridiculed. If you see some of the things that some of these quote unquote group leaders say behind people's backs, it's just absolutely appalling. If somebody is paying you to teach them, you should be able to teach them. That's all I'm going to say about that. Let's go ahead and start learning. Okay. How many people here have used the TTM Squeeze before? You can type your answers into the Discord. I can't really see what's going on in the Zoom chat because I've got this full screen. But if you have used the TTM Squeeze, just type a Y. If you're absolutely brand new to it, then just type no. You'll watch the recording? Sure, no problem. Yep, that's fine, Robbie. No worries. All right, Sam, yep, I know that you're familiar with the TTM Squeeze. Anybody else? Elliot, Kevin, TJ? All right, so first things first, I will go through the disclaimer. I used to be a licensed financial advisor here in Canada where I live. The information that's presented is for educational purposes. I'm not giving you any investment advice. You got to do your own due diligence. Don't blindly follow trade ideas or anything like that. The whole idea is that you need to be able to, fish for yourself, really, right? And I know that that's a common saying, but the idea is that, somewhere down the line, you will no longer need somebody to guide you along the way. It's absolutely fine if, you want to keep in touch and, hey, things are going great, or, hey, I need to meet with you. That's absolutely okay. But my idea is that anybody who works with me, who does my one-on-one mentoring, you guys know that my policy is that I don't want to work with you forever. It's just that simple. However many sessions you need, that's fine. We'll get through that. But the idea is that by the time you're done, you are entirely self-sufficient. That is what I want for everybody that I work with, okay? A little bit about me, those of you that, have worked with me in the past, you already know a lot of this. You missed a small chat. Yeah, it is great. We have some good conversations. So I'm glad we have this little group here now. And, I do want to keep it small. I don't want to just kind of open it up to the general population because then it just gets out of control. So I'm not going to bore you guys with this. Basically, I've been in the industry for a long time. I've been trading, for about 20 years. I've been teaching at a college this is my 13th year now. Taught a whole bunch of courses. I'm a mentor with the CMT Association's Investment Challenge. So I did that last year. I did the first one this year. I'll be doing the next one in the summer. I've got a few designations in the industry. I feel that I'm qualified to, teach and guide people about trading. What I'm going to suggest is that if you are looking to learn from somebody, make sure that they know what they are teaching you, okay? With the way FinTwit is and, the whole entire, social media, whatever, with everything that's going on with all of these different pop-up groups, right? You'll see somebody who was learning 6 months ago and now they've started their own group. To me, that's kind of like, okay, well, you're in grade 1, now you're trying to teach the kindergartens. Sure, if you've learned a lot, great, but I don't know how much you can possibly learn in a year or 2 or, even a few. You need that experience through different market cycles, having a tried, trusted, and true system that you can rely on that will work through the different market conditions, okay? And that's what the TTM Squeeze is all about. So how do I trade? I use a combination of indicators to enter positions during periods of consolidation. And I look to exit after an expansion and price action. So I primarily trade options. You guys know that. I've traded stock, I've traded futures, options on futures, etc. The great thing about the TTM Squeeze is that you can use it for any security on any time frame, right? The indicators that I use for TradingView are as follows. So I use the paid version of the TTM Squeeze. I'll go into what they are, show you all the free versions, etc. The paid version of the TTM Squeeze is like $700 or $800, I think. It's not cheap. But there's a fantastic version for free on TradingView. It's the Squeeze Pro by Mackett. There's also the regular Squeeze on TOS. It's free. But with that, you don't get the low compression and the high compression squeezes. You just get the regular squeeze. I use the Keltner channel bands. That's by Sehun. Stacked moving averages by Divanalis. So with the 8, 21, 34, 55, and 89 with shading. Don't worry, I'll show you guys my charts in just a sec. I also use the 200 simple moving average, simply because that's what a lot of technical analysts look at. And so when everybody's paying attention to it, it kind of becomes a self-fulfilling prophecy. I also use an indicator from TraderLion, which is part of the IBD or Investors Business Daily world. If you've ever studied the works of William O'Neill, who just passed away recently, he was a big proponent of a combination of fundamentals and technical analysis, and we'll talk about his system and how I've drawn from a lot of the things that he's come up with or he's discovered or put together, whatever. And so I use that indicator from TraderLion simply because volume is very important, right? You've got price, volume, and time. Now, for those of you that are straters, we all know that we focus on price. However, I found that for me personally, now there's nothing wrong with the strat. Let's all pray for Rob because we know he's going through some challenges right now. So we definitely keep him in our prayers. And there's nothing wrong with the strat. But for me personally, I just found that I was a lot more consistent and I was a lot more profitable trading my old system. It's not that I couldn't trade the strat. It's just that for my personality, for the way that I trade, the restrictions I have through work in terms of, how often I can trade, and, I pay $9.95 a commission, $9.95 a trade plus $1.25 a contract as my commissions, right? So I don't have free commissions. I can't use stop losses on options orders, anything like that. So for me personally, this was just a much better system for me to use. If you don't have those types of restrictions and you're still comfortable with trading the strat, that's fine. You can use the strat with the TTM squeeze. Okay. And in fact, if you can couple the two, you know, say you get a 2-1-2 reversal at the 21 EMA, that's a very powerful trade. Okay. There's huge potential there. Okay, great. So what is the squeeze and the Squeeze Pro? So the squeeze was created by John Carter of Simpler Trading. I've taken so many courses from John Carter over the years. If there was one person who I could say had the greatest impact on my trading, it's John Carter. I actually have, so one day I was in a session with him and I just basically asked him, like, you know, give me some advice. And he was like, trade smaller, trade better, trade less, make more money, buy at the mean, so the 21 EMA, sell at +2 ATR. And then he said something that really stuck with me. In fact, I have this piece of paper in one of those plastic display thingies that, you know, stands up on your desk. And it says, things will change when you get tired of the BS you're putting yourself through. It's like, base hits pay the bills. Entries are a dime a dozen. It's the exits that make you money. So I know, Rob, you wanted to talk about stops, so I'll talk about that here as well. But essentially, it's all about doing the same thing over and over again, okay? If you have a repeatable process, you will have a predictable outcome. Trading does not need to be complicated. Simplify your trading as much as you possibly can. I have nothing against the strat. I have nothing against ICT or smart money concepts or Elliott wave or GAN or anything else, okay? For me, I've just found this to be the most reliable system that I've come across that fits me and my trading style the best, okay? I'm never going to tell you that there's a right way to trade. Whatever works best for you and your account is the right way to trade. But there's always room for improvement, okay? So John F. Carter, part of Simpler Trading, you know, he's put out all kinds of content over the years. He made, I think it was $21 million. Was it last year or the year before? You know, he posts all of his trades. He'll actually tell people that he's getting into this trade so that people can get in before him rather than, you know, getting into a trade and then alerting it and then, you know, benefiting from hundreds or thousands of members jumping into the same trade and driving up the price. So the squeeze is available for free, as I mentioned. If you're looking for it on TradingView, it looks like this. So the Squeeze Pro, so these are the arrows and the Squeeze Pro indicator. I found it to be like 98% accurate to the official Squeeze Pro from Simpler Trading. The Squeeze Pro arrows, it's another great tool. It simply tells you when that squeeze is about to fire. Okay, it's not a requirement. I usually don't even have it on my charts anymore, but it is useful if you're just trying to learn or you kind of want a heads up. If you're in TOS, you can find the squeeze here under John Carter Studies and then the TTM Squeeze. Okay. I believe there are free versions of the TTM Squeeze out there for TOS. I just don't have that available right now. So if anybody knows of anything, by all means, feel free to share in the group. As long as it's not copywritten material, like don't post the official paid version because that's obviously a problem. But definitely there are some free ones that people have created. So check those out. So now, what is the TTM squeeze? How does it form? When we say there's a squeeze, what are we actually referring to? So the TTM squeeze uses a combination of the Bollinger Bands and the Keltner channels. So the Bollinger Bands track plus and minus 2 standard deviations, right? It's just looking at a measure of volatility. What's the dispersion of price above and below a moving average. The Keltner channels use the average true range, which is basically just a calculation of how much price moves on average over the last 2 weeks, or basically 14 days. And the idea behind it is it's used to identify periods of consolidation or contraction of volatility. So a squeeze will form when the Bollinger Bands contract to be within the Keltner channels. Okay, and so all that means is that, let me pull up my chart for you guys here. So let me just clear all of these off. All right, so we'll just get rid of all of these. And let me go to Bitcoin because that trades all the time. So let's remove the indicators. So this is just a regular price action. The Bollinger Bands will track plus and minus 2 standard deviations. So basically, was it 95% of price action will take place within these bands. Then we have the Keltner channels. The Keltner channels track the average true range. So Keltner channels. All right, so let me just change the coloring here just so it's a little bit easier for you guys to see. We'll get rid of the basis. We will make these yellow. Right. And so these are the Keltner channels. And we'll make these, we'll keep these blue. We'll remove the background. Right. And so all that we are looking for is when the Bollinger Bands contract, so the yellow lines contract to be within the blue lines is really the simplest way to put it. Okay. So the Bollinger Bands are measuring price dispersion or volatility, and the Keltner channel is telling us what's happened over the last 2 weeks. So you can see here how Bitcoin over the last few days, or a couple of days really, a couple of weeks, has been consolidating. And so you can see that when price broke out, the bands widened. The screen is so small. It's on my 32-inch monitor. All right, let's try this. Give me 1 sec. Thanks for letting me know. Stop share. Let's share this one here. Screen 1. All right, is that better? Should be okay now. Okay, great. So all that happens is the Keltner channels will contract to be within, the Bollinger Bands will contract to be within the Keltner channels. So you can see how price, expanded. We broke out of this consolidation range here. It was slowly moving downwards and then boom, popped higher. And now you can see that we've just been trading in this range. Hence the reason why the Bollinger Bands have now contracted, and we should now have a squeeze on the daily chart. And so if I put that up, let's actually see if we've got one. Right, and so there you go. And I'll explain what the different colors mean here in just a second. So right now we are in a squeeze. The reason why we want to position ourselves when we are in a squeeze is because prices are contracting. Things are calm. One of the reasons why I stopped trading the strat is also because there would be times when I would be looking to get into a position using the strat, but using my old system, I'd actually be looking to exit the position. And so I prefer to buy when things are calm. Options premiums, as an options trader, options premium, especially if implied volatility, is very important. So I want implied volatility to be lower. And then when you get that massive move out of price consolidation, so like back here, you can see that this squeeze fired and it just took off like a rocket. This is the reason why we want to position ourselves when we're in the squeeze, as opposed to, getting in once it's already started to move. So you will find that if you compare the squeeze system with the strat, there will be many times where they will contradict. If you can get them both to line up at the same time, that's great. But for me, I have just found that the best way for me to trade is to just trade with the TTM squeeze. I don't even put the strat on there anymore, really. So that's basically how it works. There are 3 types of squeezes. The 3 types of squeezes are the low, which will usually be the black or the gray dots, depending on how you have your charts set up. So like here, you'll have the medium, which is the red, and then you'll have the high compression squeeze, which is the orange. I'm not sure of the exact settings. If I'm not mistaken, it's 2.5. So it's when the Bollinger Bands contract to be within 2.5 of the Keltner channel, so plus and minus 2.5 ATR. For the low compression or the black dot squeeze, the regular one is 2, and then we've got 1.5 for the orange. I'd have to confirm it, but it's basically increasing levels of price consolidation or contraction. And then we look to determine the direction that the squeeze is likely to fire. Remember, it's not a certainty, it's just a higher probability. When we're trading, we're always looking at putting the probabilities in our favor. So the direction is usually determined by using regular technical analysis. So how does the squeeze work? You start off with green, which means there is no squeeze, right? And so let me switch back to this here. Do you guys see the progression of the squeeze on your screen? Can you hear me? You should see a bunch of colored dots on the screen.
No, I can see it.
Okay, great. So the progression of the squeeze, it might be a little small right now, but I'm going to show it to you side by side. So you'll have the green, which means there is no squeeze. Okay. First, you will have a black dot or a gray dot if you're using the dark mode or the black background. The only time you can have, or the only squeeze that can be as a standalone is the black dot squeeze. Okay. When you go to red, what that actually means is that you have a red dot squeeze on top of a black dot squeeze. Your screen went blank? Okay, how about now? Oh, that's your internet? Okay. And so you'll have a red dot squeeze on top of the black dot squeeze. And then if it continues to compress, you actually have an orange on top of the red on top of the black. When that squeeze starts to fire, the first one that will fire is the orange, as you can see here. Then you will be back into a red dot squeeze. When that fires, then you'll have the black dot squeeze. And then you will have finally back to green once that black dot squeeze fires. Okay, does it make sense so far? Okay, good. So how do you set it up? If you are using TradingView, right, and you are using that indicator, the Squeeze Pro by Mackett, it should look like this, which is on the screen. You'll need to adjust the colors. Okay, so the first thing that you want to do is make sure that the colors are set up correctly. So if you're using regular or light mode, then color 3 down here will be black. Otherwise, you'll use gray just so that you can see the dots, right? So this is why I have these gray dots. This is actually the black dot squeeze. So if I had a white background, it would look like this. But if you're using dark mode, just change it to gray so you can see it. Leave momentum the same. You'll need to change this color to gray. You'll need color 1 to be orange. Color 2 remains the same. Color 3 changed to gray. So that's the black dot squeeze. Okay. So the keys to a clean squeeze. So now let's start getting into what we're actually looking for. So these are the rules. You can print them out. You can copy them, use them however you want. But if I'm looking for a long setup, this is what I'm looking for. So the stock needs to be in a daily squeeze. It doesn't necessarily have to be a stock. It could be crypto. It could be a currency. It could be anything. But your number one rule is no squeeze, no trade, period, end of story, right? Remember that we are looking to do the same thing over and over and over again. It should get to the point where you are actually bored with your entries and your exits, okay? Because when you do the same thing over and over again, you know what the likely outcome is going to be. The squeeze is not 100%. Nothing is 100%, okay? But if it is in a long setup, so you have a clean squeeze, the probability of it firing to the long side, as in the trend continuing, is, over 70%. So you have a pretty good chance, a high probability that the squeeze will fire long. So how do we actually determine if we are looking to go long? That's the reason why I have the shaded background on my charts, and I'll show you that here in just a sec. So we're looking for the exponential moving averages. We use the 8, the 21, the 34, the 55, the 89. For those of you that aren't familiar or didn't recognize what those numbers are, they are part of the Fibonacci sequence. Okay, we don't use the 13 EMA simply because it's just right between the 8 and the 21, and there's not really much benefit to using it. Okay, so 8, 21, 34, 55, 89, and then I use the 200 simple moving average as well. We are looking for the stock to be above its 34 EMA. We're looking for momentum. I'll talk about momentum here in just a second when we get to a live chart. We're looking for momentum to be positive, so above 0. It can be yellow. That's what we call a slingshot squeeze, but I'll explain that here in just a second. If you're using the Squeeze Pro arrows, we're looking for a buy arrow. Okay, so the arrow would just be pointing up. If it meets those conditions, we are then looking for an options contract. I prefer the Delta 70 with a minimum of 30 days to expiry, so 30 to 45 days. So right now we'd be looking at the August expiration. There's nothing wrong with going with more time than you need, but don't buy less time, in my opinion. Okay, I find that from my personal trading, whenever I start taking short-term contracts, I don't trade well. Maybe I need to size down. Maybe I just need to, avoid it altogether. But for me personally, I find that, if I'm trying to trade a daily squeeze, but I'm buying a weekly contract, it usually just doesn't work out, right? So 30 to 45 days is my preference. You can go with more time. Some of the trades that I took recently, like Riot, for example, I had the September contracts. Really all depends on what you're comfortable with. But as John Carter taught me, give yourself the gift of time. The contracts might be a little bit more expensive, and this might not be something that you guys are used to. But I have found that if you buy better contracts, you have better results, okay? Percentage-wise, you're not going to have those 1,000% returns. It's very unlikely. It's possible, but it's unlikely. But you will make more money based on those contracts, right? So if you take, say, a Delta 70 versus a Delta 20, for the same type of move, you're probably going to make more money with the higher deltas. And I'll show you guys some examples. And then we start looking to take our profits at +2 and +3 ATR. This is something that right now I'm working with a couple of people to try and refine, because if you've been following in the chat, you'll know that I had a few trades that had I held on even for another week, I would have made a lot of money, okay? And I'll show you guys those here in just a second. This part here, I'm going to skip over for now, simply because it's a little bit more advanced and I want you guys to learn just the long setup first before talking about the reversion to the mean, okay? And so it's important to watch the direction of the 8 EMA and the momentum on the squeeze indicator. So anything that is not a textbook clean setup is a potential short, but you need to assess each individual setup on its own, okay? Each trade is different. So setting up the Keltner channel bands, if you're using the one by Sehun, you'll just change the inputs. So I removed the plus and minus 1 ATR. I just don't need to see them. However, while we're on this point, I will, I'll go through that part about setting a stop. So if you are buying options contracts, or even, you're buying shares or futures or whatever, pay close attention to the average true range. The average true range is how much that ticker is or has moved on average over the past 14 trading days. Why is that important? Because if you set your stop within plus or minus 1 ATR, you have a very good probability that price will trade to your stop level. So, I know that the strat teaches you to keep tight stops, and that's fine if you're trading the strat. But you'll notice that if you're trading the TTM squeeze, or if you look at any of my examples for my trades, I don't keep super tight stops because the trade needs to be able to work itself out. If you're trading common shares with the strat, absolutely, the low of the previous candle or the low of that candle, that's fine. Options are a little bit different, right? And we'll talk about that, down the road. So I change the lines to circles so that I can easily spot the difference between the EMAs and the Keltner channel bands. And then I don't have the background plotted. So I'll show you guys that here in just a second. So this here is the Keltner channel, or are the Keltner channel bands. So this is plus and minus 2 ATR, these red dots, and then plus and minus 3 ATR are the blue dots. I want these on my charts at all times so that I can see when it's highly probable that price could start to revert back to that 21 EMA. I have no problem buying at the 21 and selling at plus 2 ATR. And I can do that day after day after day and be pretty consistent with my trading. The reason why right now we're looking at, refining this a little is simply because we want to be able to stay in our winning trades as long as they continue winning, right? One of the things that I picked up from the IBD community is that they will hang on to their winners as long as they possibly can, right? Whether it's days, weeks, months, or even years in some cases. And so I figured that if I can use that along with the system that I'm currently using, and I can increase my profitability, why not? And I do fairly well right now. You guys have seen some of my trades. But like for example, if I was still holding Riot, I would have taken the rest of the year off that way, right? And we'll talk about that here in just a second. So the stacked EMAs, what do they look like? Here's the 8, 21, 34, 55, 89, and then this red line here is the 200. You'll notice here that they start to cluster. The reason why I have the background shaded is simply because if I'm flipping through a lot of charts, I don't want to sit there and have to, oh, is this stacked or is this not? The background will automatically shade itself. And that right off the bat tells me, okay, EMAs are stacked positive. Very easy way to just filter out good trades versus, maybe not A+ setups. And then I use the enhanced volume. The reason why I use the enhanced volume is because it will tell you what the up volume is, the down volume, and then most importantly, when we're looking for breakouts or, a squeeze firing, we want to see these high volume nodes, right? Again, this is something that we get from the IBD community. So let's look at some charts. Let me skip over this here for a second. And so this is an actual trade that I took a while back. I was in at 1920. This was off of the 30-minute chart. It was when? 2022. So over a year ago. In at 1920, out at 32. That was on one contract. That was in 2 hours. And I'll talk to you guys here about the power of 9 in just a second and why and how I came up with that. but you can see you had a nice setup. Boom, right? This is a Mara trade that I took, right? So here was my entry. Here was my stop. My profit target was up here. So I was in this trade April 7th to 11th. I took my profits here. If you guys were in the stat room at the time, I did do a write-up on it. I called it discipline over dollars. Basically, I left a lot of money on the table because if we look at where Mara traded after that, it ended up around 12 or 13 bucks. Now, I had a fair amount of contracts. I think on that trade, it was like 45, 50 contracts, maybe 60. I'd have to check. But, you know, after reviewing my trade, which is very important, if you guys are not reviewing your trades, you want to make sure that you are, because you will learn from them. Whether you make money or not, you can still learn from your trades. So, you know, I was in here. I did buy out of the money because this was looking like it was ready to go. And I was basing it off of the Bitcoin chart. So if you go back to April and you look at it, you'll see the kind of move that it made. And then, you know, 1-2 days, boom, got up to +2 ATR. I suspected it could have stopped here at the 200. That's just regular technical analysis. But I was up a fair amount, right? I was up, I think, 5 grand on that. And I would have made like 15 or 20 grand had I held on for a little bit longer. But when I went back and reviewed my trade, I did exactly what I was supposed to do. It was a 5 out of 5 trade. I bought at the 21. I sold at the +2 ATR. And this is one of those cases where you actually did get a strat setup, right? You had the 2 down, the inside bar, and then the 2 up. With the TTM squeeze, you got in here around 765. With the strat, you got in around 825. So in that case, it did work out to be better. This was a trade that I took back in June, Mara, right? Same idea. You can see how we were just consolidating for the longest time. Just look at the length of that orange dot squeeze. I got in here. I don't know why I got in here. Oh, because we gapped above. Here's our strike price, profit target. I was expecting a huge move on this, all right? You can see what happened. And so here's the actual trade confirmation. One thing that you guys will notice is that I do post my transaction report, right? So if I do take a trade, I actually post the trade that I take. You don't see this from a lot of groups or group leaders for a variety of reasons. Number one, they might not be trading real money. They might not be trading at all. The other thing is that they might not be trading, you know, any sort of size, right? If you're a group leader and you're charging, you know, $100 plus a month, but you're trading, you know, 5 shares at a time, doesn't really look too good on you as a group leader or mentor, coach, whatever. So in this case, I did take 64 contracts. You can see I started at 14 here at $1.28. I added to it at $1.50, and then I sold it here the next day for $3. This was the August 11th contract. You guys can do the math on how much that's worth today. Mara is now at, was it $19? It hit almost 20. So those would have been worth $9 a share, or sorry, $9 a contract, just from the intrinsic value. Yeah, Sheesh is right. Yeah. Oh, just wait until I show you Riot. So, you know, here is what it all looks like. Now, it looks like a lot, right? If you look at my charts, it looks very busy. It's really not. Once you know what you're looking for, and this here I keep for illustrative purposes, but what I'll usually do is I will take everything except the 821 and 200 off of my charts, just so that I have a few less lines. Because the most important thing is, do we have stacked moving averages? If we do, then the background will be shaded. The reason why I have this Fibonacci retracement here is I was looking at where it could go, right? And then where it could extend to. And we actually did hit all of these targets. Another thing that you'll notice that I do is that I mark up my charts exactly like this, right? What's my entry? What's my strike? What's my profit target? Where's my stop? And it's not on the screen here because it was August, but I also have a vertical blue line where I put my contract expiry. That makes it very easy for me to have my plan right on my chart. I don't need to write it down on a piece of paper, put it in a spreadsheet, anything. I just put it on the chart, and then if it closes below my stop, I exit. If it gets to my profit target, I exit. It's really just that simple, right? And I highly suggest that you do the same thing, simply because your entire trade plan is here. All you do now is you take a screenshot, you dump it into OneNote or TradeZilla or TraderSync or whatever it is that you're using. Could be a Word doc, could be PowerPoint, whatever, but it makes it easy. So now at this moment in time, I know exactly what that chart looked like. When I go back and review it, it makes it very easy for me to analyze my results. One of the most important things that you can do as a trader is all of that extra work that is not directly part of buying and selling. It's everything that you do before and after that that really makes the difference as a trader. And for those of you that have worked with me, you can attest to the fact that, this is one of the things that I'm always harping on you guys to do. Did you do this? Did you do this? Did you do this? Did you do this? And once you start doing it, you'll see how your results start to, as if by magic, improve. It's not magic. It's just we're paying more attention to it, right? Because if I've got a red line on my chart that says stop, then there's no questions about it. I know that's what I need to do. My trade plan is right here. It's 5 lines on a chart. It's super simple. So for me, it's, set yourself up to win. Make things as easy as you can for you to be successful. Trading is not hard in terms of making a trade plan, okay? It's simple. It's not easy to be a trader. Exactly. That work also makes you skip some bad trades. The number of times that I wanted to buy like a weekly contract, for example, and then I look at it and I'm like, whoa, it doesn't seem like we've got enough time for that trade to work out. And then I'll buy more time. Or like you said, skip bad trades. Sometimes I go back and I look and I'm like, yeah, I probably shouldn't have taken that trade. And that's all it is, right? It's improving the things you need to improve on. But if you can eliminate your biggest mistakes as a trader, your results will improve drastically, right? And that's really all it's about, is we want to be consistent. It's not about making money. I know we trade to make money. Our primary goal as traders, honestly, is to trade as best as we can, to, as much as possible, take the best setups that we can, the high probability trades. Where's my entry? Where's my exit? Where's my stop? What strike am I to take? What's my contract expiry? Do that over and over and over again and start to see how your results improve. It really does work. I know, because I've used it myself, and the students that I've mentored have used it, and they can attest to that as well. Okay. Do the same things over and over again, long enough consistently, and you will find the results with your trading. Okay. So here's another example. This is ISRG off of a 30-minute chart. I don't know why this was set up like this, probably when I took the screenshot, whatever. So, you can see here, we had a squeeze down here at the bottom. So you had plenty of opportunities to buy at the 21. It got up to +2. You had numerous opportunities again. You could have taken this trade here again. So on the same squeeze, you could have, basically used one line to catch 2 fish, if you think about it, right? Now, it doesn't look like it's a lot, but it's a pretty decent trade, right? If you were in here around 303 and you were selling around 306, that's a $3 move. And when we talk about the power of 9, especially when we're looking at these higher dollar stocks on a 30-minute or a 78-minute chart, you can crank out some pretty decent results over time just by taking, small bites. Again, it's relative to your account size, of course. So what I want to show you now are some examples, right? I'll make this presentation available in case it's difficult to read, but it's really important to go through and look at the charts as to what's a good squeeze and what's not a good squeeze. Like, what's a clean setup? Would I go short here? Would I go long here? Or would I just say, you know what? I don't know. I'll find a better trade. Because you don't need to waste your capital, mental capital, emotional capital, etc., on bad setups. There are plenty of good setups if you know where to look, okay? So here's an example. Oh, sorry, I didn't explain momentum. I just realized that. So we know what the regular squeeze is, right? So green means no squeeze, black means low compression, red means regular compression, yellow means, or orange means high compression. These waves, or the histogram that you see above and below, that is related to what is going on with momentum. If momentum is light blue, it means that it is above zero and it's increasing. Think of this as you are in the car and you've got your foot on the gas. The car is moving forward and it's accelerating. When it changes to dark blue, you are still moving forward, right? Momentum is still positive, but it's starting to slow down. So the car is still going forward, but you've taken your foot off of the gas. Now, when it goes red, that actually means that now you're starting to go in reverse. Okay, so basically momentum has now shifted to negative. And then yellow can sometimes be confusing. If you have moving averages that are, stacked negative, so in this case, the background would be shaded red. I'll show you an example here in just a minute. If you have yellow momentum, it's the same as having light blue momentum on a long setup, right? So it's increasing. Oh, sorry, it's the same as dark blue. So increasing, but slowing down and changing direction. This is negative, so accelerating to the downside. And then yellow is basically bottomed and starting to move positive again. If you have a regular squeeze with yellow momentum, it is fine to take that trade long, but you need to pay attention to what's going on with the moving averages. And it'll make a little bit more sense when we have some examples. So here's a squeeze. We have a squeeze here, but we are not at the 21 EMA. This is not a good setup. I would not want to take this trade because this is already extended. Now, it was profitable, but remember, discipline over dollars. Get into the habit of taking the setups where you have the highest probability. Then here you can see that the EMA is shifted. We then had a squeeze. So they're no longer stacked positive. In this case, I'm looking for a short setup. You could have taken it here at the 21 EMA. Your target would have been down here at -2. Here, the squeeze had red momentum. Okay. Next, this is a clean long setup. So we have momentum. It shifted from red to yellow. And now we are looking to go to the upside. So here we had a chance to get in. Could have taken profits there. Can you see it now? So this was not a clean squeeze because we were too high. Okay, good. Here you can see that we took this at the 21. We're looking to go short because the EMAs have crossed. So the background is no longer stacked. It's no longer green, so it means it's not stacked positive. And then here you can see that we had stacked EMAs again. Momentum had shifted. So we could have gotten in here. There's your first one. Here, there's your second one. And here's your third one. And this one was just an absolute monster. Right. And so this is why I'm looking to be using the 8 EMA as a trailing stop. But we'll talk about that here. And you can see, the type of move that happened. So we consolidated, right? We just kind of chopped around here, but when we made that move, it was huge. Okay. Here's NVIDIA. This was recent. This was off a 30-minute chart. You can see that the EMAs were starting to cross. We had a decent squeeze here. So you could have positioned yourself here. I honestly would have taken my profits here. And then boom, you can see it gapped up. Right. That's the same slide. That's my Mara trade. Riot. Okay. This, I usually don't get emotional as a trader, right? I'm used to leaving money on the table. But this trade hurts, okay? I had 98 contracts of the September 15th $13 strike. Riot went above $20. Okay. This trade right? So the day I took this, was $1.69. These were going for like $7, $8 a pop. So when I put it through option strat last week, it would have been worth about $70,000, profit of 70 grand. I sold for 6K. Now 6K is not chump change, right? That's a lot of money. Like 6K is, if you can do one of those trades a month, you're living pretty decent. I sold way too early. Okay. I made 6K. I'm thankful for it, right? Like to make 6K on a trade is pretty good. Yeah, way too early. But if you make 6K overnight, there's nothing wrong with that. And I suspected that it could have kept going, but it's just one of those things, right? Yeah, miners went nuts. Miners went absolutely nuts. Yeah. And I mean, if I would have held on, sure. But at the same time, I don't know if you guys trade Mara and Riot often or follow Bitcoin, but you'll know that you can wake up one morning and see Bitcoin down 5% for absolutely no reason, right? And so if I was up 5 grand or 6 grand on the trade and I wake up the next morning and I'm down 1,000, that's no bueno for me. So I would much rather take profit and, rinse and repeat, rinse and repeat, rinse and repeat than, try and maybe hold out for more profits. But it's always a work in progress, right? Which is why when we go back and we review our trades, it's like, look, this was a 5 out of 5 trade. I got in where I was supposed to. I exited where I was supposed to. But what can I do to improve? And that's all we're doing as traders is we're always looking for how we can continue to improve. So how do we scan for squeezes? There's a lot of free scripts for TOS. I'll see if I can find them. I run a scan on TradingView, but I also pay for a scanner from Simpler Trader, right? It cost me $1,000 for the year. I bought it when it was like whatever, 30, 40% off. I just paid for the whole year. It was easy. Otherwise, it costs $100 a month. If you want to get it, great. You don't necessarily need it, but it does simplify things, right? If you have a lot of other stuff, if you work full time, whatever. For me, I found that it saved me so much more time. So how do you run it in TOS? Oh, sorry, in TradingView. So under the scanner, you'll go there and you'll use these parameters, right? So I look for common stock, ADRs, ETFs, Canada and the US. I want to make sure that there's sufficient volume. And I'm looking for an average true range above 3. So these are stocks that move, right? You'll get that fluctuation within the day. And then I'm looking for strong buy, or neutral. This is what the EMAs will tell us, right? What exchanges, market caps, average volume. And then I like to look for stocks above 50. Because, if you can buy 3, 4, 5 of these contracts and it moves $10, that's a pretty good trade. That's a pretty good trade. And then I'm looking for strong buy or buy. So then how do I trade this? I prefer the daily charts. For me, the daily charts are the best possible setup for my time, right? Because I can't sit there and watch the charts all day. And so I prefer the daily chart. Remember, the higher the time frame, the more valid the signal, because you had more price action and more volume into that candle, right? I know a lot of traders. I've met a lot of traders over the years, right? There are very, very, very few traders who successfully make a lot of money trading off of a 1-minute chart or a 5-minute chart, okay? I'm not saying it's not possible. Guys who are swinging 10 ES contracts or NQ contracts, right? The E-minis, you can make a lot of money in 5 minutes if you're holding 10 contracts and you get a pop, right? But if you're trading common stock, and you buy PLTR at 1278 and your magnitude is 1284, how many shares do you actually have to trade for that to be worth your while, right? So you want to be able to determine if the person who's teaching you is actually trading, or if they're just, kind of saying, okay, this is this, and they've got a play-by-play going, right? Because to trade off of a 1-minute chart or a 5-minute chart, you need to be trading volume. You look at somebody like Jim Bradley, for example, for those of you that follow him, he will trade like 1,000 or 2,000 shares at a time, right? Sometimes he'll take 5,000 shares of something. Yes, he is an absolute beast. He is probably the most consistent trader I've ever met. Like, his track record is insane. He is in a trade, in and out, and most of the time under a minute. Okay. But he knows exactly what he's looking for, and he's in and out. Bam. He's not looking to make 50K on a trade. He's looking to crank out a few hundred or a few thousand every single day. Are there more efficient ways? I see people criticizing him all the time. Oh yeah, you could trade options and you could do this and you could do that and you can make so much more money. Why don't you trade SPX? And it's like, dude, the guy's worth millions. If he can, make $1,000 in 30 seconds and then go off and do something else for the rest of his day, power to him, right? But he's, an exception to the rule. Many others are either paper trading or they're not trading real money, or they're not really trading size. So you want to watch out, right? Because a person who is not, doesn't have skin in the game, doesn't have the same alignment of goals as you do, right? Because it's easy to say, okay, hey, we're alerting this at this price, but if you're trading off of a 5-minute chart, I'm not saying you can't. I'm just saying it's not very likely that you are going to be very profitable, okay? Unless you're swinging, 100 contracts at a time. In which case, sure, you can make a lot of money in 5 minutes. I'm not saying this to brag. It was a very degenerate trade in hindsight. I made 10K in 11 minutes trading NVIDIA once, okay? But I had a stupid amount of size. Like, I should not have been in that trade, okay? I'm being totally honest. One thing you'll notice about me is if I have a winning trade, I try and stay humble because there's always somebody who's going to make more money. If I take a losing trade, I own up to it, right? I am human. I'm not a perfect trader. Even the best traders out there win 50, 60, 70% of the time. So anybody who doesn't show you their losses probably isn't trading real money, all right? Yeah, and then of course, an alert, right? And you don't know if they're in that trade or not. And to me, that's a big warning sign because, and I think I shared it in the group so you guys can scroll up and see, but there was one trader recently who alerted something at like 15 cents, but they got in at like 5 or 10. And then they alerted to their members and then they basically used their members as exit liquidity. So these options contracts that you see that are like 5 cents, 10 cents, 15 cents, 20 cents, be very careful, right? Anything under 50 cents, if somebody's alerting that trade, you're probably being front run. I'm being totally honest, okay? Now, can you make money with those trades? Yes, but if I, hypothetically have 500 contracts that I bought, over a couple of days at 10, 15, 20 cents, and then I alert it to my 500,000, however many members, and say, buy this up to, 25 cents, and I'm in at 10 and 15, of course, I'm going to be able to show these, multiple 100% returns. Watch out for that. If the person shows you where they got in and where they got out, that's a different story. That's being transparent, right? And you'll notice that a lot of the trades we take in this room, my contracts are usually not 50 cents. They're usually $1 plus. Sometimes, Sam, you remember when we were at the other group where, some of my contracts were like $3,000, right? It's pretty hard to front run, a room where you've got 3 or 4 contracts of a $3,000 contract, right? So watch out for these things because these are the things that they're red flags. And, it's like when you're looking for suspicious activity, especially with a lot of these rooms, one red flag, another red flag, another red flag. I remember how we had a compliance presentation years ago, and they said, when you're looking for suspicious activity, think of it as being in a dark room, right? And each thing that you find is like lighting a candle, right? So one candle, another candle, another candle, another candle, another candle. All of a sudden you're like, oh, hold on a second. Something's going on here, right? Watch out for these things. If you don't know where that trade, if you don't know where the person alerting the trade got into that trade, you better be cautious. Okay. Yeah. I mean, you remember some of those end phase trades that we took, like how much money do you need to move? How much money do you need to have to move a $300, $500 stock, right? A lot. You don't need a lot of money to move a 5-cent contract. And in reality, it's pretty hard to get filled on size with some of these penny contracts, right? You saw my Riot trade. It was a $16,000 position size. Can you imagine I was trying to buy $16,000 worth of a 10-cent contract? By the time I got filled, it would be like $5, right? Just because of the volume. The market maker is not just going to sell you that many contracts. You're going to have to pay up. So just keep that in mind, right? I know I'm harping on this a lot, but I want you guys to open your eyes and to see what's going on in this industry, right? So I prefer daily charts. I like the 195, the 130, the 78. The reason why we have these kind of weird, they're not even timeframes is because the cash session is 390 minutes. So if you're trading off of an hourly chart, you have half an hour from the previous day, and then you have half an hour from the new day. So that candle is kind of out of sync. And then of course you have gaps, etc. But if you use the 195, that's basically 2 bars per day. The 130, that's 3 bars per day. The 78, it's like what, 5 bars per day. You can use the 39-minute chart. I personally, I don't prefer that. I like the 30-minute because it fits nice and even, right? Especially if you're trading the strat. If I was a full-time trainer, I'd be looking at something like the 78-minute chart, right? Think about the potential of the power of 9. For those of you that aren't familiar with it, I'll go through it here pretty quickly. If you can get a $3 move with a Delta 70 contract, right? That's about $210 plus some gamma, maybe a spike in implied volatility. We'll call it 225, right? So $3 move with a Delta 70 contract, $225, right? All else being equal. And if you can do that with 3 contracts, that's $675. Okay, that's not bad. Now, if you can do that 3 times a week, that's just over $2,000 a week. If you can do that consistently, 3 trades a week, right? Your $3 move with 3 contracts 3 times a week, right? 3 plus 3 plus 3, that's the power of 9. That's about $2,000 a week. Over 50 trading weeks of the year, you would average over $100,000. How do you eat an elephant? 1 bite at a time, right? You look at that Google trade that I took. You look at the NVIDIA trade that I took on Friday, right? A few of us ate off of that trade. You look at BA. You look at a lot of these other tickers that we've traded recently. We're not looking for that 5% move in one day. If that happens while we're holding, fantastic, right? But I know that if I buy at the 21, I sell it +2 ATR off of a 30-minute chart, something like NVIDIA, Tesla, Microsoft, Enphase, a lot of these names that are, $250 plus, you can very easily get, a $5, $6, $7, $10 move sometimes, right? Look at Tesla, look at NVIDIA, right? And so if you can just crank out those trades consistently, you can do pretty well, right? I had 4 contracts of NVIDIA on Friday, and I made, I think it was like $1,200. Now, if I can do that 3 times a week, knowing what we know about the squeeze and the average true range, do you not think that it's possible to, consistently grind out profits from the market? We don't need these massive moves. All we need are, $3 moves, 3 contracts, 3 times a week, right? So 78-minute charts for me, if I was full-time, I'd be looking at the 78-minute chart. 30-minute chart as well is great. If you're looking to swing trade, the daily chart's fantastic, right? So if I'm trading the 30 or the 78, if it's Monday, Tuesday, or Wednesday morning, I will go out to Friday's expiry. If it's like Wednesday afternoon, I'll go out to the following week. Okay. The 195, the 130, I'm usually looking at about 3 weeks. The daily, I'm looking at about 30 to 45 days out. If you're trading on a weekly chart, or if I'm trading on a weekly chart, I'm looking at about 3 months out. And if you're looking at a monthly chart, you're looking at least 6 months. Remember that I prefer the Delta 70s, right? This is how I learned it from John Carter. And there's a reason behind it, right? If you buy the Delta 70, you get the benefit of gamma, right? So we know that you've got delta, which is the rate of change between the options price and the underlying security. So how much will your contract move for a $1 move of the underlying? Delta 70 means if the stock goes up $1, your option should go up 70 cents, all else being equal. If you go with like a Delta 90, it's going to be a lot more expensive, but you're not going to get that gamma bump, right? That boost from gamma is where it's the rate of change between your options price and your delta, right? So gamma is how much your delta would increase for a $1 move. So if your first dollar was 70 and you had a gamma of 5, the next dollar that it moves, your option should go up 75 cents because you would add your gamma to your delta. And we'll talk about this in greater detail down the road. I avoid out of the money unless you're very confident, unless you're buying a lot of time. That's usually what I do, right? So if I'm buying like September, I'll go 1 strike out of the money. Usually not more than that, okay? And so the Delta 70 is kind of your sweet spot because you don't have as much of an impact of implied volatility. You get that gamma bump. And if it goes up $2, $3, $4, $5, some of these contracts, and anybody who's traded these contracts and has seen how they move, when you sell, you could be at like a Delta 90, Delta 92, 93. So you're almost dollar for dollar at that point, and you have very little time decay and lesser impact of implied volatility at that point. So stops. Well, let's talk about stops here. You can use a chart-based stop, right? So if I am looking at, right? So let's use BA here as an example, right? I set my stop all the way down here. Actually, you know what? Let's go to Palantir was a great one, right? So when I took this trade, this is a trade that we actually took recently. So where did I set my stop? I could have set my stop down here, but that doesn't make a lot of sense. Why does that not make a lot of sense? Because it's within, like I'm so close to the 21. I want to give my trade at least room to work itself out. And so the reason why I chose my stop down here is because at this point, if we went from here down to here, this is obviously a broken setup. Like market structure would have changed and the whole thing is done and over with, right? It wouldn't make sense to stay past this point. But if you set your stop too close and you're within plus or minus 1 ATR, you're almost certain to be getting stopped out because that's the normal price range for that stock, right? And so here was my entry. I took the $15 strike. So, basically at the money. You can see we had a nice pop and I sold at my first profit target. A couple of days later, it reached the second profit target. And, if you stuck with this trade, you're still in profit and you still have a lot of time. So it really all depends. I have no problem taking money off at the first and second target. Like it's rinse and repeat, right? This is riot, right? Look at that. I was taking profits here and then it ran another few bucks, right? Mara, I don't think it's marked up anymore. IONQ, here's another great example, right? I took this trade back here, right? And you can see my charts, they all look the same, right? NVIDIA, this was a short trade that I took, so I'm actually still in this right now. We won't talk about reversion to the mean today. Here's BA, right? So we took this trade. They all look the same. We're buying at the 21, we're selling at plus 2 ATR, right? SoFi, same thing. Tesla, same thing. Cleveland Cliffs, same thing. PLTR, same thing. Riot, same thing. Do you notice a pattern? All of my charts look exactly the same, right? ENVX, same thing. This was a big one we missed. Like I sold here, this was my profit target up here, and then it just ran. So I sold at 15, it's hit 21, right? So how do you stay in these trades? ARRY, this one was a bust, right? This one just didn't work out. But you can see how it's the same thing over and over again. It doesn't have to be complicated. I'm not looking for a 212. I'm not looking for a 312. I'm not looking for, whatever. I'm looking to buy at the 21 with a squeeze. I'm looking to sell at +2 ATR, right? BA is actually setting up here again, right? So if I was going to take this trade, this time around, my entry zone would be here, right? You can just move that actually. Why not? So my entry zone would be there. Where would I keep my stop? Well, logical point for my stop at this point would be down here. Because if we took out this pivot, it means something has changed, right? What strike price would I take? This is 205. We're currently at 213. Yeah, I would take the 205. Nothing wrong with that. First profit target would then be this recent high, which is also +2 ATR, and then start looking at some of these extensions, right? CRM. Do you guys remember CRM? We took this last week. Cinemaxon isn't here today, but we took this trade. I think Brandon took this trade as well, if you're listening to the recording. Same thing. Like we got in here and then boom. And I sold at like 220 and here we are at 232. And so, but that's the thing. Do you know what it's going to do? Because, Robbie, if you're watching, look at Roblox, right? If you take your profit at target, it goes to the next target. If you were still holding on to this trade, it drops from 44 down to 43. Not a huge amount, but look at how much profit you gave back, right? So just a few examples. Does that make sense to everybody? Do you see how we're looking for the same thing over and over and over and over and over again? Doesn't matter the time frame. Doesn't matter the ticker. It's the same thing over and over again. So are we good? Any questions? Thank you. Right, so that's the chart-based stopped. The dollar-based, so you can say, okay, if I'm buying a stock for $200, I'm going to set my stop at -20% or -25%, whatever you're comfortable with. Keep in mind that the chart does not care where your stop is, okay? So if you set your stops too tight, one of the main reasons why people get stopped out a lot is because their stop is too tight. Now, I understand capital preservation, right? You guys will always hear me say manage risk first, right? To quote a fellow CMT, Matt Paralia, he says that you are a risk manager first. Only once you have fulfilled those obligations as a risk manager do you become a trader. So always manage your risk first, okay? If you're setting it based on a dollar amount and you get stopped out all the time, maybe you need to pick better setups. Maybe you need to find a different way to set your stop, okay? So you can set it based on dollars. You can say, okay, this contract costs, $1,000. I'm willing to risk 300. You can base it on a percentage. It's entirely up to you, right? The way I do it is I use this chart to stop me out because I need to see an actual change in the market structure. There will be times where I'll be down 10, 15, 20%. If the setup is still good and I still have capacity maybe to add to it, then I might add to it until I get to a full position. There's a difference between averaging down and scaling in. Scaling in is like you're building a position, right? So similar to that Mara trade, I bought some at, $1.28, and then I added more at $1.50, right? If I would have bought some at $1.50 and then added, when I was at $1.28, as long as I'm still working towards my full position size, because, if you're trading 1 or 2 contracts, it doesn't really make that much of a difference, right? If you start trading 50, 70, 100 plus contracts, it might take you a while to get that good fill. Okay, so keep that in mind. I want to talk briefly about time-based stops here before we call it a day, because a time-based stop is very important. We know that options lose value because of time decay, right? Theta or theta, depending on where you are in the world. So with a time-based stop, if I'm buying, if I'm trading, say, a daily squeeze, and I buy 30 days to expiry, and that still, after 2 weeks or 10 days, if it hasn't made the move that I'm expecting, I will either exit the trade or I will roll that trade. Because at that point, the last 10 days to expiry, your time decay starts to accelerate, right? So it becomes exponential in terms of the time decay. So we're okay with, getting in. I'll skip over all this stuff here. Oops. I'm like, you're okay with, oh, where did we go? Sorry. What do you guys see on my screen right now? Kind of sucks, and I lost my train of thought. Oh. Right, here we go. So if we're looking at time decay here, you can see how 30 to 45 days, we have time decay, but it's not that bad, right? Within the last 30 days, it really starts to accelerate, but here it's almost like straight down, right? So we're looking to buy 30 to 45 days. If I'm buying 45 days and, 2 weeks passes and there's 30 days to expiry and that squeeze still hasn't fired, I can roll it out. It's fine. You don't want to be stuck in a situation where, you've held this for 3 weeks and it still hasn't moved. Now it could happen, but it's not really likely. So for me, my best trades are when I get in and it starts to go, right? Those are your best trades, where as soon as you get in, it starts to move in your direction, right? Some of the other trades, maybe it takes a little bit more time to work out for it to work out, but you don't want to get in the habit of trying to hold your trades for too long while it's not moving, right? Holding a winning trade, that's a different story. That's something that, admittedly, I'm still working on. I leave a lot more money on the table than I make. And I'm okay with that because I can still be pretty consistent, right? My Mara trade, I think I made 5 on that Mara trade a while back, and then I made 15. And then I think I made 6 off of Riot. 1,200 here, 1,500 here, it adds up. Yeah, 6 to 10 days, usually I'm done with it as well. Like if it's gonna move, it's gonna move, right? And you'd be surprised how many times you'll get into a trade and within a day or two, it fires. So I have no problem getting in when there's 1 or 2 dots on the squeeze. I know John Carter says he likes to wait for like 5 or 6 dots, but he also says that if he sees a 1 dot squeeze, he'll take it. It's just, he usually doesn't see them because, they come and they go so quickly. So that's it for tonight's class. Does anybody have any questions? We covered a fair amount of material. I had 58 slides. I think we only got through like 30 of them. So definitely more material that we can cover. So maybe we'll do these like 1-hour segments every so often. But I hope you guys have a better understanding of what the TTM squeeze is, how it works, and how we use it. Right? The whole idea is we're looking to buy when prices are consolidating. Think of it as, an inside bar, right? For you straters out there. An inside bar is consolidation. We're looking to buy when there's a consolidation. Now, a lot of people will say they don't trade inside bars. That's entirely up to them, right? If you can make money from trading a certain way, or your rules say don't trade when you have an inside bar, that's okay. I just find that limiting yourself when there are perfectly valid trades out there is detrimental to your trading in the long run, right? I've been doing this long enough to know what works, what doesn't work. And I find for me that if there's a clean setup, there's no reason for me not to take it, right? We're not thinking about the next trade. The next trade is not going to matter in the grand scheme of things. Start thinking in terms of the next 1,000 trades. When you're thinking of the next 1,000 trades, if you win 60% of the time, that means that you will have 600 winning trades, but you will have 400 losing trades. Think about that over 1,000 trades. You think about it over 10 trades, you're going to win 6, you're going to lose 4, right? On average. So losing trades happen. They are the cost of doing business as a trader, but do not let them ruin you, right? No big losses. If that means that you have to position size smaller, position size smaller. You know, smaller position size, wider stop. That's an acceptable trading method for many people, if that works for you. Big position size, wide stop, recipe for disaster. Okay. So that's it for me. I do have another call that I have to get to. I do hope that you guys found value in this. Any feedback is appreciated. If you have any questions, feel free to type them in the chat. Otherwise, take care, everyone. Have a good night. I'm not around tomorrow. I'm taking my daughter horseback riding, and then we're staying at a hotel at Niagara Falls for the night, and then I think we're doing either Marineland or African Line Safari the day after. So I won't be trading tomorrow, but I will have my phone most of the day, unless something cataclysmic happens. I'm not going to be exiting any trades or entering any trades. But that's it for me. Take care. Have a good night, everyone, and bye for now.